Welcome to SmithWeekly Discussions, an occasional program for our readers and listeners of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. Today we have Los Angeles-based Old West Investment Management on the line. The firm is represented by Brian Lax, portfolio manager and partner of Old West. Old West is an organization that is adhering to the code of the West. Brian, thanks for coming on.
Hey, thanks for having me.
Okay, Brian, so give us an overview of the firm, the funds under management, your background, and the routine stuff.
Yeah, so Old West, we've been around for just over 10 years now. We have about $200 million in assets under management across a few different strategies. We have 3 partnerships, one's a typical long short, one's more income focused, and then another one is the one that we recently launched, which is the Uranium focused fund. And then we have a few other long only strategies. And so I would say the assets are probably split half and half across those 2 buckets. And then my background, I joined here a little over 2 years ago. I came from a finance background, MBA, CFA, worked as an energy analyst for a few years, covering mainly oil and gas exploration and production. And then when I joined here, it was more of a generalist role. We're pretty small, just I think 5 or 6 people. So got to wear a lot of hats, but at the same time, we have a pretty significant value orientation. So, a lot of the things that haven't gone up, or, we kind of look for these contrarian areas, that was a lot of commodities, natural resource. So kind of my experience came in handy. And then, we've followed uranium for a while, and then made kind of more of a bigger push into it recently with this new fund.
Okay, and tell us about the founders. Give us some information on them.
Yeah, so the Boskoviches, the family was originally in farming, 100 years ago. Came here. My boss, the CIO, he worked in the family business for a while, and then maybe 30 years ago or so, kind of made the transition into finance. I guess the story he likes to tell is he was on the board of a bank, I think, or he worked for a bank where he saw the, chairman or one of the management buying a bunch of stock every quarter, and he said, "Hey, can I buy some stock too?" And so they were, kind of started buying the stock, and eventually, the company ended up getting sold. And so our, one of our big philosophies is watching insiders. Do they have skin in the game? Are they buying their own stock as a good indicator for potential investments? And so that sort of experience resonated with him and kind of carried over into his investment philosophy. And then around that time, I think he joined up with one of his colleagues, I think maybe it was his broker, and they started a firm called, or joined a firm called Alethea, which was another sort of value-focused investment shop that had really good growth for a number of years. At that time, his son came on board. They did very well in terms of asset growth, and then I think they had a little falling out. So he ended up starting this firm kind of right around 2008. Went with, kind of bootstrapped. I think we started with 10 or 20 million and just had pretty good steady growth since then to kind of the 200 million level where we are today. So like I said, the kind of philosophy has always been a heavy focus on the people involved, insider ownership. Are there smart investors involved? And then looking at, insider buys and sells as sort of a, more unique starting screen for sourcing investment ideas.
Right. Okay. So, what are some of the trends that Old West sees in the markets today?
Well, I guess one of the things that we've struggled with is being a value fund up until a few months ago, at least, in a market that just seemed to go up and up all day or every day, with a handful of names leading the way, the FANG stocks, and the whole sort of shift to passive investing, and how just in general most value-oriented investment philosophies have lagged behind, and so we kind of grapple with that constantly. It seems maybe we're starting to see a little shift there with the volatility of the last few months, but really, I mean, we're kind of just call it deep value guys. I actually got a little bit of a chuckle listening to the interview you did with Mike Alkin, I don't know, maybe a couple weeks ago, where you talked about some of the areas you're looking at, and it was very, very similar to the ones we look at, which are ones that are deeply out of favor. Sentiment is poor. Valuations are depressed, and yet there's some sort of catalyst on the horizon where you'd expect the fundamentals to improve. And if you're patient, you can probably make a good return just by kind of holding your nose and buying these things. And so a lot of these areas are what we find in our portfolio today. Some of the natural resources, commodities, energy, stuff that hasn't really participated in the 10-year bull market that we've had since '08.
Right. Yeah, no, it's you got to have a tough stomach to look at some of this stuff, and you got to be able to fight the the urge to constantly do something, and also at the same time for you guys trying to satisfy your clients and convincing clients that this is the place to be. And so it's difficult, and for us too, as a writing research and newsletters, it's difficult because different clients have different expectations and different horizons, and you try to weigh that and also try to get everybody kind of on the same board and under the same thought process and kind of the same stomach and the same patience, and it's difficult to be able to do that. And so it's an interesting challenge. And then today, for you guys, where do you guys see the big market today, and where is it headed over the next 12 months?
You mean the market overall?
Yes.
Well, I think I'd be nervous if I had general market exposure. We're pretty concentrated into some of these areas that we would hope or expect will do well when some of the ones that have really been the driving force over the last several years start to give up the ghost. I mean, there's been this expectation that growth will eventually run out of steam, and there should be this rotation to value, and financial assets have outperformed commodities by a huge margin. There might be some mean reversion. Obviously that hasn't played out. Maybe you're starting to see the beginnings of it, but we are fairly cautious. Maybe to a fault. It hasn't really paid well to have short exposure over the last few years, which we do in our partnerships, and then some of our long positions are naturally more defensive. But you see on days like today or months like the last couple months, defensive positioning can work out for you. So we, I guess, would say you look at a lot of these metrics, and maybe not just price to earnings or some of these more naive metrics where they can be sort of fooled around with by company managements, buying back stock or levering up and doing whatnot. But price to sales or some of these other things, this market it seems pretty frothy, and so when we see moves like today or yesterday or the last couple months, we're not necessarily surprised by it. We wouldn't be surprised if it continues, and we're, quite comfortable with our positioning. It seems, at least the last few years, with just sort of the go-go momentum of these stocks, we've been, kind of on our heels and defending our positioning to clients, saying, look, this thing, yeah, it's nice and all. You kind of just blindly buy the FANG stocks or these momentum stocks and you make a bunch of money, but how long is that going to last? It's tough to have that go on while have this caution that some people might think is unwarranted, but then all of a sudden you get hit with the volatility of this year, and now people are like, oh, hey, maybe there was something to that. So yeah, we see what's going on today and think, this might just be the start of something, so we're pretty happy with not having changed our philosophy at how we approach this, because we think, eventually we'll be rewarded. And, thankfully our client base is mostly, high net worth, sort of sticky money that is, they're patient. They're more invested they understand the process. They understand the philosophy. They know that these things go in waves. Sometimes the pendulum swings pretty far to one end, but eventually, sort of traditional valuation metrics should win the day. And so as long as they understand that, they're willing to let these sort of extremes play out, and over the long run, we should do very well.
Right. No, and it's interesting how February 2018 this year, the lows that were there, and the kind of the three tests. If you go back to look at the S&P chart, kind of the three tests that played out in that time frame, and then the 6 months, starting around March, or I guess April, the 6 months it took to reach a new high and then a breakdown where we are now, and then yet today a third test potentially, and I see it reverse quite differently today, but a third test was in play earlier today, where you have testing, is it going to break, and then head down to the February lows. So it's interesting to see how this will kind of play out going forward, and it does make sense to be cautious, certainly to have insurances in place, like we've discussed before, and I've mentioned a few times in the last couple months. It doesn't hurt to be, those shorts and the insurances, yeah, they're not paying off right now, but you know what, when things really go down and kind of the rug gets jerked out, it will start to pay off quite nicely, and so it'll be interesting to see kind of how the next 12 months goes, and continue to keep cash. So moving on. So you guys spend a good amount of time in the People's Republic of California. What do you think of the energy policy of the state, and do you see California in kind of a declining state of affairs, or is the best days still yet to come?
I'm not that optimistic about it. I think we sort of have resigned ourselves to accept it, and we rather think, okay, how do we deal with it? Instead of trying to hope for a better day, think, let's just say this is sort of the baseline, and if it gets better, great, but let's not pin our hopes on something improving dramatically. So yeah, I think it's kind of I don't know if shame is the right word, but it's troubling that that's the way it goes here, but that's the way it goes here, so we just sort of deal with it.
Right. Okay. Well, I thought I'd throw that one in there. So back to the big market stuff. Can you give the listeners an example or even a name of how you guys might, or just a strategy, how you guys might employ, your hedge on the downside, a short or an insurance type strategy?
Sure. Well, we actually had a really successful one earlier this year. Over the last year or so, we've grappled with how to best, prepare ourselves for an environment like this. Do we do single name shorts, specific companies? Are we short, sectors, ETFs, kind of the broad indices? Should we use puts? And then if so, how far out in terms of strike or expiration? So we've been kind of going through all these iterations. Most of our shorts have been single name historically. Um, we started looking more at options last year. I had some experience with it in the past. They hadn't done much of that here before I had arrived, but it was one sort of, we were just trying to see what's the best bang for our buck. And after the market rising continually, what's going to have sort of the lowest carrying cost, right? I mean, it's nice to have shorts, but if the market just rises nonstop, it really is a significant drag. And so we started looking at potentially using more options for our short exposure, because we could minimize our capital at risk. We could potentially enhance the return profile if we were right. And so, we thought, okay, well, where's the best place to apply this? And, at the time, even with volatility low, it was still pretty expensive to hedge just the general market decline, buying S&P puts or, puts on the Qs if you wanted to take a view against the tech stocks, which had really driven the market. So, and not only that, instead of trying to just say, okay, I think the thing's going to turn, you're also now saying, well, how much is it going to go and how long does it take? So there's a few other dimensions to that made it more difficult. And so, as we're watching this and noodling through all this stuff, the market keeps going, higher and higher. Volatility got lower and lower. I mean, at one point, I think it was single digits at the end of last year, beginning of this year. So one of the ways that we expressed our view of how to hedge ourselves, sort of, what was the most bang for the buck? We were looking for these sort of asymmetric payoffs, and what we narrowed into, there was a lot of good work being done kind of end of last year on these volatility products, especially these inverse ETFs, how much money was flowing into them, this feedback loop that was going on where, retail guys would flood in and they'd put this money in this thing because it had gone up, 5 or 7 times. And that fund would then short volatility via the futures. And it was, that would drive the price down. It would drive the ETF up. And it was, this feedback loop. And so we realized, especially as volatility got lower and lower, that, that sort of dynamic could reverse itself pretty quickly if there was any sort of shock to the market. And the lower that volatility went, that spring just coiled tighter and tighter. So we had it wasn't ours alone. I mean, there were some pretty good guys doing work on this. Artemis Capital was one of them. I think Morgan Stanley had some good reports on this VIX dynamic. So we, we're able to buy some of these, really cheap out of the money puts on those VIX, those inverse volatility ETFs. I mean, people were just giving them away. I guess people didn't think or imagine that the market could ever go down. This was kind of maybe December, January timeframe where, the market was just ticking up every day by a little bit. You got really, really low volatility. So for us, it was like, well, the lower this thing goes in terms of volatility, the higher the market goes steadily. The lower the threshold was for there, any sort of dislocation in the market to just trigger a huge unwind. I mean, if you think about it, when the VIX was at 8, right, and historically would trade at 20, well, if the VIX were to double, you'd still be below historical levels of volatility. And, back in, the stress times, I mean, it would spike to 40 or 50 or even higher. So we thought, well, if you have even a minor sort of dislocation in the market, these things would easily double. And if that's the case, well, those products would blow up. And sure enough, in February, that's just what we had. So we had some puts that paid off. I think it was over 100 to 1. And so we've had a pretty good year in some of the funds that have had those. But that's just an example of, thinking of what you're trying to accomplish, spending time on it, and then trying to find what is the best way to express that view, or at least how do you get paid the most if that view you have does come to pass.
Right. And what was the term on the puts? How
Well,
long?
so we were just going 1 month out, and then I think we only had to roll them, a couple of times, because we realized that, unlike going, taking a short view on some company where maybe you want a longer term because you're trying to accumulate downside that, grows over time as a stock sells off. We realized that, this was going to be a one-day event if it happened, because, the lower that volatility went, the more likely it was that any sort of small move caused those things to unwind. So we thought, if this thing plays out, it's going to play out as a single event. So there's no real reason to have a long term to expiration. It's better just to say, hey, we don't need to buy all that time premium. We know that. So we would usually do it about a month out. And then, if actually what's funny is our CIO was a little upset, I think, because it happened on the 4th or 5th of February, and the January ones had just expired, like maybe a week or two earlier, and we had sort of double the exposure. It was kind of overlapped, so it would have been a really big day had it happened a week earlier. But I think it was a really and that sort of thing doesn't happen all the time, so maybe that's an unusual thing. But I just use that as an example of maybe played out over a few months, but we'd been looking at it for a long time, thinking about this. How do you get this exposure? What's the best way to do this? And so that sort of continual, sharpening of the sword and trying to figure out how to best take advantage of something that happens, and then you get that sort of windfall at the end.
So what's one now that you guys might have in place, as on the short insurance side?
Well, so we do it more in this new fund. It's sort of especially on the puts, because look, I think that's a preferable risk return structure. I mean, you kind of flip it on its head. Now you have a limited downside and then potentially much greater upside. We look at all these tech names that have had these huge runs, that, where we don't think the fundamentals have supported that. I mean, you look at valuations, they're historically high. And so like on a day today, I mean, that well, at least earlier today, they've come back a little bit, but that's a nice source of return when there's all this panic selling. Is you have this sort of portion of your portfolio in puts, where you can potentially harvest that and redeploy into some of these names that are, babies getting thrown out with the bathwater. But, suffice to say, there's a lot of, just look at what's driven the market over the last couple of years. And so we have, there's probably 10 or 15 companies that we have that we look at. And, I hesitate to mention any names in case these CEOs don't like having their companies bet against, but you can probably get an idea. I think you've talked about some in the past even, but in some of your other interviews. But, suffice to say, stocks that have gone up a lot where the fundamentals don't support it, and now you're starting to see them come down a bunch. And so, especially in October when you saw a lot of the market crack, it was a lot of those names.
Right, and they need to understand it's part of the market. There's the upside, and then there's the downside. So all parts play in, and nothing goes up forever, and so they need to respect that. And with that too is the leading stocks that have happened since 2013, 2014, and onward, or maybe even before that. They lead to the upside. And then there's a very, very solid argument that they're going to probably lead on the downside. And the obvious point of that is they get overbought, and then they get oversold, and that's over a long period of time. And so when you have everybody piling into these certain names, we already know what they are: the Googles, the Amazons, the Netflixes, the Teslas, and so
Mm-hmm.
forth. There's others, and they are naturally going to lead on the downside because that's where the most people are. That's where the most liquidity is, and so they're gonna get cleaned on the downside just like in much faster fashion.
Yeah, well, and we think that the shift to passive investing that's happened has really driven a lot of that because there's so much money piling into these indices, and it's all getting diverted to they're cap weighted, so it's getting put into these big names, and a lot of these guys that are buying, retail investors that are buying, a spider ETF, or you're buying some tech ETF. You're not looking at the valuations of each of these individual companies. You just want exposure. And so when you have this big $1 trillion of capital getting pushed into there, the rich are getting richer. It's this same sort of feedback loop of, a dollar goes in, 10 cents goes into this company. It makes it go up, and then people are happy. Their ETFs are going up, so they pile in more. It's that sort of indiscriminate buying that when they start selling, it's just as indiscriminate, and it's going to hit those bigger companies just as disproportionately as it did when it came in. So, that's why I think the puts were preferable to the shorts, because you don't really know when that turn happens, and so it's tough to be sitting on shorting these things and just riding them up and getting killed when you can say, hey, you know what, I can get 2-year exposure. It's pretty cheap because volatility's low. I'm limited to my premium that I've paid, and yet when the thing cracks, maybe I give up the first 5 or 10% downside, but after that, I'm getting this magnifier. That sort of return profile really seems better for us. We like that better than just going straight short.
Right, and there's 2021 puts out there now, and if you get into some of the more exotic stuff, if you jump over to different exchanges, there's stuff that's listed in Europe. You can get some put warrants, and you can get some real other, excuse my language, evil shit that has even more leverage to some of this stuff. So it's interesting what some of these other exchanges have available outside of the U.S. But yeah, in the U.S., I think you can get out certainly on some of the products at 2021, in some cases 2022 at this point. And so it's nice because you have a fixed price. You're in it for a fixed price, and really, if you consider the price you paid for the time, and assuming you can purchase them right, be patient, and get good prices in the market for these things, it's not bad. And you know what? If you're wrong and it expires, so what? That's the price of insurance you paid for, and it really did its purpose. So that's kind of how we try to look at it as well. So moving on, let's see, what specific investment are you excited about today, and give us a name or the commodity or whatever, and why it has your interest.
Well, it's got to be uranium. I I think that's the reason for the season, right? That was, we've owned it for a while. I guess we've watched it for a while. We owned Cameco across a few of our funds, which sort of seemed, kind of the safest way to play it as we wait for the turn. But like we discussed earlier, I think we're looking for these areas that are beaten up, out of favor, not necessarily in secular decline, but ones where we think that something's going to change in the future, and there's some sort of catalyst that's going to get us there. And I'm hard pressed to find a better area of the market than uranium, because I think that it has all of those things. One, it's got the extreme depressed sentiment, the depressed valuations. The market's been decimated in terms of number of companies, in terms of the total cap of the space, and yet fundamentals are improving. Seems to be by the day. There's a number of catalysts on the horizon, so we think it's one of the more attractive areas from a risk reward standpoint. And look, I don't think we're alone in that. You've done a lot of good interviews with people who think the same.
Right, and it is highly attractive, and it's extremely unique, that particular market. It's more unique than in a lot of other minerals and commodities by a long shot. It's really an interesting, unique space. The total cap, as you suggested, I'm not sure what. Well, let's just put it this way: there's weed stocks that have a bigger cap than the entire uranium mining business today. So a single weed stock outdoes the entire uranium mining business, and yet the uranium mining business is whether you look at it as a positive thing or a negative thing, it's a necessary evil. And so you have to look at the fact that these minerals do come out of the ground, they get processed, and they eventually find their way to a nuclear plant throughout the entire cycle. And we need that if we're going to charge our electric vehicle at night, or our telephones, or use air conditioning, or whatever we might use to enjoy modern life. So it is a very interesting situation. It's something that certainly is a win question, and the demand and supply situation is lining up very, very nicely, and so it really, really is interesting, and we'll get into it just a little bit more in a moment. But let me change gears just a little bit. So assuming the big market, crashes out over the next 2 years to the tune of a 50% decline, where would you focus your capital? Would you go half of the capital in uranium and the other half in McDonald's?
Well, are you talking about during or after the crash?
Well, afterwards.
Well, yeah. I mean, I think if that were the case, our portfolio of puts would do extremely well, and we'd be able to, harvest that and redeploy. And look, I think we have less general market exposure than maybe the average person or fund. We're pretty concentrated in some of these areas. So really, it would depend on how does that general market crash affect the value of our holdings. And look, it's tough to say, we're so defensive and look at these great, cheap stocks that we own. They're not going to get hurt at all. These things are going to get hurt. I mean, look at some of the uranium names today. Their market's down. They're still getting hit. So look, cheap stocks can get cheaper. That's why I think it's nice to have different portions of the portfolio that can do well in different environments. And so if that does come to pass, well, there is a significant part of our portfolio that will do very well and that we can, harvest or, trim and then redeploy it to the areas, especially if we think it's, baby's getting thrown out with the bathwater. Because look, yes, we think the areas that we own are extremely cheap and catalyst rich. And if the market happens to crash, dragging some of these things down with us or with it before the catalysts play out, well, we just look at it as a way to accumulate more shares at a cheap level. And so, at least with this new fund, which is a little more concentrated, I don't know if you're referring to our general funds or the one that's more focused on resources and uranium. I think we would be looking to continue to add to these things, because personally, I believe that these sectors will do well. I wouldn't say regardless of what the overall market does, but they'll be less correlated. They will still probably have some downside beta to them, but I'd be happy to. I'm a firm believer in the long-term outlooks for these things. So if I'm able to generate some cash during that downturn and bring down my average cost of some of these things in the near term, well, that's going to be great come when this eventually plays out as we believe it does, because that's just going to increase our return. So I don't want to kind of just wave it off and say I don't care about a crash. I mean, obviously that's going to affect a lot of things. Your clients will be concerned. Certain stocks will get hit, but I actually would think, hey, if take uranium, if the sector does have its own legs, roughly independent of what's going on in the rest of the world, because it's got its own dynamic, well, potentially you have a rotation into the space. And, it's like we said, the cap's 10 billion of the whole space. It's any sort of capital flow in there. I mean, you saw what happened to crypto, what's going on with the cannabis stocks. There's a lot of people that sort of, what's the next thing to go? This seems to have some real solid dynamics supporting it. So, not only could it kind of take off on its own merits, but there could be, a whole shift of capital that's thinking, hey, everything else is going to hell. Where should we hide out? How about this area that's crucial to the global economy and seems to have some pretty positive fundamentals behind it? So we're pretty excited about the outlook for it. And I mean, yeah, I guess 50% crash in the market would probably, it'd probably hurt in a few different ways, but we have a lot of things that we think will do well in that environment. We haven't really talked about precious metals, but we do have some good gold exposure. We think that's sort of long overdue. Maybe might be a little longer time horizon for that to play out, especially given the dollar strength as all these things start to collapse. But we think that a number of these different areas should do well in that environment, and so we're not calling for a crash, but we'd hope that we would do a lot better than the average Joe if it does come to pass.
Right. Well, there's a number of points. So give me a rough figure percentage wise. So you got two funds, and at different times throughout the time context, one fund may support the other, one may do better than the other, and then the other one may outperform later. So give us right now kind of an idea of percentage wise what you guys are kind of camping out with as dry powder.
Well, so I view the put portfolio as sort of as the dry powder. So I guess, and I'm just referring to the fund that I manage, because that one has this sort of viewpoint. So because one, it's not necessarily cash, but it's going to turn to cash in a big market downturn. As it's done today. Even today, we were sort of moving some things around. So it's less about having this big bundle of cash and more about having what's gonna be more valuable in that scenario, because then we can sort of turn that into cash and then check the rubble and see if there's anything that we want to redeploy that into. So I would say at this point we're maybe 10-ish% in some of these puts. And we've probably harvested some over the last 2 months in the big market downturn, but it's still roughly around that level. And I guess the other point to that is, if the market does crash 50%, what is the response? Not just from the market participants, but do they come back to QE? Is there some sort of regulatory thing? You see Trump out there tweeting all the time. What's he going to do? There's enough panic already when the market drops whatever it has, a couple thousand points. What's going to happen if it really starts to hit the fan? That's I was just chatting with one of my coworkers today. This perhaps the fact that these moves are so violent may provoke a response sooner than if this was just a steady 100-point Dow bleed every day for the next few months. So I wonder if it does really get volatile, if you don't see some sort of people come in and try to save the day, and that was speculation that a lot of people had, was they were just raising the interest rates to give them ammo for the next crisis, sort of thing. And so maybe that's what happens, and that's why we like our gold exposure. And so I've heard some people refer to gold as cash. Obviously the miners don't seem to respect that thought, but you'd think theoretically if there's a big flight to safety, safe haven trade, and gold goes up, the miners should probably break out of their slumber, and then that could potentially be converted to cash. But our job is to be fairly fully invested, and let our clients do their own sort of allocation. They know how we're positioned, but within that we do have some of these defensive plays, and we do have some puts that we think can provide us cash if stuff does get pretty rough.
Right, and the options, certainly the puts would certainly represent that, and metals, certainly gold would represent that, because depending on what vehicle you're using, you could move that and move it into cash if you were ready to deploy into some equities towards the bottom. So yeah, that and cash, of course. And then the other thing too that people need to consider is like you said, what will be the response in the natural resource sector, and we're already in some of these contrarian areas that have been blowed out for many years, and so the response may be, is it more of a 2001 2002 response, because quite honestly, uranium and a number of minerals and precious metals commodities, just about everything in the natural resource space did quite well, held up very well during that time. And then of course, if you look at 2008, it was completely different, where you had a quick washout across the board, and then of course the things that started to respond early on were of course the gold and the equities and some of the commodities and stuff responded quicker than say the other stuff. I would just say that having some capital available or convertible towards that area where it makes sense to start buying, whether it's in the resource sector would obviously represent some good sales. Uranium would represent good sales, and then for us too on the safer side, there's going to be some incredible opportunities in the bond market when this all kind of comes down, and so the bond market will be very attractive for those looking for pennies on the dollar bonds with a nice coupon, so you kind of get paid while you wait. So that to us looks attractive. It's something we're watching. Obviously, there's not many opportunities today, but when it does come down, there'll be some significant bond opportunities. And then too, it's kind of on the safer side, the kind of the robust end. When there's a McDonald's or a Travelers Insurance or a Pfizer or some of these heavy duty, robust global companies, the global elites, when they come down, also they will, those will represent a nice kind of area to kind of sit in kind of a safe area, and they'll kind of be stewards of your capital while you kind of wait as well. So I think
that's why you hear a lot of these good investors keep a significant amount of cash. If not some of these more convertible things, they keep cash because these sorts of environments should be viewed as opportunities, right? I mean, if you're heavily levered into some of these go-go stocks and all of a sudden the market crashes 50%, well, you're probably going down with it. But if you are cautiously positioned and you have some dry powder or some ability to get dry powder, you should welcome these sorts of environments because they're giving you the opportunity to pick up pretty high quality names at bargain basement prices. And so, that's why I say, if this thing does crash and it drags some of these areas, the cheap get cheaper. Well, hey, I liked it when it was cheap. I'll probably like it when it was cheaper, especially if the fundamentals haven't deteriorated at all, and we still think some of these catalysts are going to play out.
Right. So walk us through a couple things here. So time horizon at Old West. So what do you guys typically look for with your just give us maybe a couple ideas, a couple examples of time horizon. What do you guys look at? Looking 1, 2, 3, 5 years out, and then tell us roughly. Just you don't have to give us accurate numbers, obviously, but give us a rough dollar range of or the percentage of deployments into these deals. So are you looking at position sizes of 5, 8%, 10%, or is it more heavy duty than that? So time horizon, capital deployed in any one position, and then give us an example or just run us through what the approach is of the evaluation of these opportunities.
Sure. So, and you just mean in general across the funds, not necessarily the uranium ones?
Why don't you give us an example of both?
Okay. Yeah. So, time horizon, we're long-term investors. We hope to buy these companies and hold them for as long as the foreseeable future, let them compound, let them do their thing. And that's really why we focus a lot on the people involved, and the sort of owner operators that have skin in the game, because we think, let them do their thing, let them run. There's no reason for us really to trade these things. And so we'll build positions over time and we'll just let them go. So we don't really have a sort of fixed time horizon, but we plan on holding for the long term. And then in terms of weighting, we run pretty concentrated. I think in our various funds, depending, maybe the ones that are smaller holdings will look maybe to a 3 to 6% position. In some of the funds that have a few more names, maybe 2 to 3%. So if they grow, we'll let them get bigger than that. We're comfortable. We have some positions that are maybe 9%ish, but we don't want to have we don't want to get too heavy in one name, because there's always the black swan type events that come out, and that can hit you when the fundamentals otherwise are still good. So I guess for specific names, I mean, there's a few different ways, a few different investment theses we have, or sort of style of investments. Some are just your typical, hey, high return on capital, trading at a discount for some reason, and we'll get involved where we think things are improving and we like the management. I mean, I can walk you through a few, or one or two of the names that I've sort of been instrumental in finding and going through the thought process of. One of them, sure. Let's think of a good one for you. So we're involved in this company called Enphase Energy, which makes microinverters, solar power equipment for solar panels. We looked at this. We've been in it for a while now. This kind of falls in the bucket of turnarounds and distressed investments that we think the valuation is not given credit for potential improvement, and then where we see different management players get involved, and insider ownership changing, stuff like that. So Enphase, they make these components for solar panels to convert the electricity. They were high flying at one point. I think they were several $100 million market cap. Hit hard times after 2014. When oil prices collapsed and the whole renewable space sort of fell along with it. So when we got involved, it was kind of circling the drain. Wasn't doing very well, and then that's when we'll start looking at these sorts of things. Look at, especially because we looked at who owned it, and I think it was Dan Loeb was in there, and we saw I think Kleiner Perkins, and there was a really stacked shareholder deck for some sort of tech company that looked like it was on its way out. So that sort of piqued our interest. Then we saw TJ Roberts, who was the CEO of Cypress. He got involved, put some money in, and that really piqued our interest, because he has a pretty storied career in the technology space. And so we're like, what's this guy doing looking around here? And I had actually been familiar with the name from my last role when I covered energy, because I remember this was probably 2012 when they had come out doing their IPO. And so kind of that these sorts of things add up, right? And we look at so many different names throughout the days and weeks that you'll see something from one and you'll kind of file it away, and then you'll see something else, and then maybe you'll take another look at that. But so we started doing more work on it. And, why is this guy getting involved? What's the plan here? And the company's trying to restructure. They're doing these high cost debt stuff. They're issuing equity. They brought in another guy from Cyprus. But so, sort of long story short, we think, man, there's a good chance that this company, if they had a great product, right? And so we thought, look, they're gonna, basically, they're well represented around the world. They just couldn't get their costs under control. And so if they can bring in someone that's able to do that task, well, the issue was not, hey, do people like the product? The issue is, can they make a buck while they're doing it? And so when we saw them, stacking the deck with this guy from, they brought in another guy from Cyprus. They were doing they brought in some consultants. It looked like there was a good chance that they could survive. And so that, we started building a position and saying, hey, the risk reward here is pretty interesting, because, the market didn't seem to be given, and this is over a longer period of time now, probably a few quarters, where we're tracking this improvement. Though that sort of situation of there you see the improvement happen in the fundamentals, and yet the market's not realizing it. And so we like those sorts of situations because, and then we saw some other investors get involved. And so for us, it's confirmation that the work we're doing, maybe we're on the right track here. And so that's been a really good company for us. The first sort of phase of the recovery was, are these guys going to survive? Okay, now they're going to survive. What's the upside? And so that now you kind of pass it off to a new phase of investors who look at these companies as a going concern and say, okay, what's the upside? Not sort of the 12 months ago doing the financial engineering to see if these guys are going to survive. So that's one way we look at things. And I guess it really depends on what the situation is. I'm more focused on that sort of thing, looking for these asymmetric risk reward opportunities. Everyone has their own style of how they find investments. And so, I'm sure if you talk to someone else at our firm, that they would maybe have their own way of looking at things. But for me, I like the ones where, it's the upside potential greatly outweighs the downside potential. And so, if you can build a basket of a few of these things, you should do pretty well on average.
Right. And when did you guys identify, and when did you guys start getting into this company that you used as an example?
So I'd have to go back and look. I'd say probably we didn't catch the ultimate bottom of it. We were probably 3 to 6 months early. I'd have to pull up a chart to look at it, but it was, it had gone from this was probably around the time that this is probably early 17, I'd want to say. So, it continued to decline. It's rare you catch the bottom of these things, but we thought there was enough there that it warranted a small position. And then, as it sort of came out of that bottom and we saw the fundamentals improving, that's when we really started to press it. And, it's been one of our better performing investments last year, this year. It's done extremely well. In fact, we probably thought originally that when it got to this level and the survival fears were gone, that we'd be out of it and let a different kind of class of investor come in. But now, talking to the company, and we're a pretty major shareholder of it, we think that there's still probably significant upside there. So we've owned it for, I don't know, maybe almost 2 years now. But like I say, these are not necessarily short-term investments. We like to find things that we can grow with them, and if that's the case, then we'll just kind of let it sit there.
Right. It looks like there's at least close to maybe over a 50% decline just in between the first part of 2017 and the mid part of 2017. There's a 50% decline before the
it takes you got to have a strong stomach for some of this stuff, right? And it was a small position at that point. We were kind of going off the fact that some of the insiders owned a bunch. There's some there were a lot of smart people making a bet that this thing wasn't going to die. So we thought, hey, that's a nice vote of confidence there. Look, right. These are probability based situations, right? They could have gone under, they could have not, but we thought, look, there are a lot of people making big bets that this thing's not going to happen. They're pretty smart. They have good track records. It's worth a look. And then when it looked like the worst was past them, the market only really started to wake up that they were getting credit for it. And we were able to build a pretty nice position in it. And then sure enough, if you have good guys operating, you're going to see that momentum continue. And it's done very well since then.
Well, at the performance rate that I'm seeing here, hopefully you guys have taken at least some of the original capital off and letting the rest ride.
Oh yeah, along the way out, because the other thing too is, right, when you build a big position and it does something like that, it becomes disproportionately weighted in your portfolio, and so and also your upside diminishes to whatever target that you originally had. So we'll usually, trim some of these things, and we'll keep a core position if the thesis remains intact. But we'll say, hey, thank you for the extra few points of extra weight here, and we'll put it towards some of our other ideas that are more earlier stage.
Right. So give us kind of the overview of the uranium focus. kind of tell us where you're looking at jurisdiction-wise. Give us some company names that you like. Give us kind of the overview of how Old West looks at it.
Yeah, so we just launched the fund about 6 months ago to focus on it. Before that, we had mainly our main exposure was Cameco, because we've owned it. That was kind of the first name that I pitched when I came across, because I'd been watching it for a while. So this was about 2 years ago. We got pretty lucky with timing. I mean, this was maybe October, November of 2016. So that was right when it had that kind of big dip down at the end of that year. So we were able to get some pretty cheap shares. We've watched it for a while since then and thought, look, we like this thesis. At that time it was still probably a while for it to play out. So we said, this is a nice place to kind of hide out in. The company's safe. It's strong. It's one of the big bellwethers of the industry. We'll know what's going on by owning this one. And so we own that for a few years across our different funds. Earlier this year, with the 232 petition getting filed, we finally put a second name in most of the funds. We got into energy fuels, just because we thought, look, the U.S. exposure is probably going to be beneficial. We liked the mill, we liked the vanadium, we liked the capacity. They sort of ticked a lot of these boxes for adding a second name to the portfolio. And then, as these milestones have passed, the cuts that have happened, Cameco shutting down MacArthur, them going into the spot market, we said, this turn looks like it's probably getting, and this is, more recently, probably middle of the year, we thought the turn looks like it's getting closer. So why don't we try to, build a more broad-based exposure here? And that was sort of the idea behind this new fund was, look, if this plays out, there's going to be a lot of companies that do very well here. What would be our best way to fully flesh out this theme? Not necessarily pick, try to pick the best name, but to say, hey, look, how do we get exposure to uranium as a theme? And so that was kind of the original idea. So our initial intent was let's build like a basket of a broad-based exposure that gives us that gives us exposure to this theme. When we looked around, it seemed like the vehicles that were out there were just there were some what we saw as flaws in their construction. There was the URA. They did that rebalancing this year where they, added a bunch of other sort of ancillary services. So it was really only, I think, half in the uranium companies themselves. There was, and then even that was pretty top heavy. I mean, I think they had Cameco was a huge weighting for them. There was that one in London, Geiger counter, where, it was looked to be more of a pure play, but at the same time, it was pretty top heavy as well. I think they had like 20% in next gen, or they still do. So we thought, well, why don't we just kind of build our own, right? There's no, what would be the ETF that we would want to own? We have this new, we can essentially do it ourselves. And so, it was at the time it was, okay, what should be in this, right? And we weren't really trying to, nitpick too much about individual companies at the time. It was just, let's see, who's got, resource, kind of the naive pounds in the ground sort of thing, where, we went through the UXC annual report and they had, hundreds of companies. Okay, which ones of these are publicly traded? Which ones of these, have measured resource? Which ones of these are pure plays? And you start, narrowing it down iteratively, and you get to, a group of the, call it 20 to 40 names that most people are familiar with. And we said, okay, let's kind of take a small portion of the fund and just build like an equal weight ETF, almost like an index fund. And that was really the first idea was, okay, here's our broad-based exposure. And look, some of those companies are going to be duds, some are going to be really well, but do really well. But we know that all these guys sort of have passed these initial cutoff filters, and so it's a nice broad-based exposure for anyone looking at uranium. And then we thought, okay, that's our first start. We'll keep this sort of block of cash, and then over time, do deep dives in all these companies, and then try to tilt it, by selectively increasing the weights in ones we think were better companies. So over time, you have kind of the cream rising to the top, but we still keep a roughly, equalish weight on these things, because we don't really want to have like a too top heavy of a construction, because there's these sort of maybe like one of these companies has problems with their mine, like Cigar Lake flooded. You saw what happened with Berkeley. They got their permit yanked or whatever. So we didn't want to have too heavy of weighting into any one name, but we wanted to still, have kind of the cream rise to the top, and then roughly equal weight down from there, give or take a percent or two. So, and so that was really where it was. And then I guess within that, you say kind of areas, we really were looking naturally at the places that had the uranium. So we have a bunch of the Athabasca developers, Africa, Australia, the U.S. of course, and then there's a small bucket that's kind of the other bucket, which is maybe some of these deposits that are in non-traditional uranium jurisdictions that maybe might be a nice option, where we'll keep a smaller position, but they have something, so maybe it ends up working out in the future. So that's kind of how we originally thought about it.
Right, and going back to some of the other stuff you said earlier, the URA is a joke. It's garbage. So that you just chuck that out. And the thing is, for you guys, is, and really for anybody, I mean, why you already have management fees at Old West. There's already costs of operating the business there. Why would you go into an ETF that's poorly structured, or why would you again, why would you buy another fund who also has a layer of administration fees and costs, G&A costs associated with a fund? Why not just look at the holdings and take a look at what other people are doing, look at some research like you guys have done, and formulate your own basket? I mean, it makes complete sense. Why would you pay double the G&A when you don't have to?
Yeah, and then that was kind of the idea was, okay, what would the ideal ETF look like? And you see, so we probably wouldn't have bought those. I think we maybe would have constructed our whole way, but we saw the flaws in each of these. And it's sad too, because you look at some of these people, like you go on Twitter or something, and you look at people looking into uranium. They say, well, why has the price gone up, but URA has gone down? You're like, well, have you looked at URA? I mean, what's going on there? I mean, you own some construction companies, and so yeah, I think it gave us the opportunity to sort of cherry pick what we thought were some of the best companies, and then over time, as we incorporate new information, we can selectively build these weightings as the market gives us opportunities.
Right. No, and you got to look at all this. You got to take a look at the jurisdictions. You got to look at what countries really do have actually uranium framework for exporting uranium and so forth. I mean, there's just a couple in Africa that have that. There's more or less as far as companies in Central and South America, or these countries here, literally just off the top of my head, I don't think there's any. Maybe a Brazil might have it, but I think some of these have controls. Like, for example, Mexico has controls as the extraction is only done by the government, more or less. So you got to look at these jurisdictions, which ones have a potential to change something, and there's a number out there. And then also, along with those kind of jurisdictional speculations about can they do it for the first time in this country. Then you have the court cases like the Virginia Uraniums. I mean, Virginia is a very, very small, tiny company, very small market cap, and it's all weighted on a court case, the Supreme Court, and dealing with the state courts. And there were some interesting insights there talking to Walter, and so it's interesting how you might treat that, because Virginia Energy, in a positive scenario, which quite honestly. With a positive EPA head, positive Department of Energy, positive NRC, a positive administration overall, and maybe a positive view from the Supreme Court, that company could have one of its best chances during this cycle to possibly do something. And even if it doesn't get there, that stock in a cycle, in a bull cycle, will probably still move. So it's interesting how you might position for some of these things and how you might speculate on some of these crazier.
Yeah, well, because I mean the pounds will still be there. So you got to think, eventually something's going to happen there, whether it's eminent domain or whether they get a new governor. But I think, going back to the earlier point, that's really why we want this broad-based exposure across these different regions, because they all have their puts and takes, right? I mean, Athabasca's got the really high grade, the low cost, but it might take 5 or 10 years to get one of these things developed. Where the Africans, yeah, it's higher cost, but I mean, some of these things are ready to go. So ironically, it might be the Africans that get the first nod, because they're just waiting for the price. And if you're a utility that really needs the pounds, you might say, all right, what was that was a really good interview you had with Goviax. I mean, he's thinking, look, we'll go at 50. We're trying to rejigger some things to maybe get a little lower than that, but it sounds like it's pretty ready to go. So even if you're a utility, you can't really go to NextGen or Denison and say, okay, give me some pounds in a few years. They're like, well, look, I know it's cheap, but you're going to have to wait till we go through the process. And so, I thought that interview you did with John at Deep Yellow and Dustin, that was great. I mean, he gave his reasons why he likes being in Namibia, and obviously Daniel at Goviax said the same thing. Is these guys, that's a big part of their economy, so they're very pragmatic about their permitting, about their regulatory environment. They're like, let's get this thing done. So really, it sounds like if you had to choose between two projects, one that is ready to go but it's a higher price, and one that's extremely low cost but it's going to take years and years. Well, if you need the pounds, it's going to be the higher price project that's going to go, at least in our opinion. And so, in fact, the Athabasca guys might benefit from that, because if it is the higher price projects that are able to bring on the near-term pounds, well, all of a sudden their projects just got a lot more valuable, because sort of that price clearing function was set by someone on a different continent, because they were ready to go. So, and then you have kind of the U.S. guys that fall somewhere in the middle of that. And it's an interesting conversation you had with Walter. He seems to be extremely optimistic about the 232 petition, and the potential for, I guess, a two-tiered price maybe if all of a sudden the U.S. guys are forced into production. And so, look, we own names in all of those areas. I mean, we think that they all have their benefits. Certain ones are going to do better at certain times. And that's why we think, rather than try to pick, okay, who's going to be the best guy in this cycle, we'll say, look, we're going to, a lot of these names are going to do extremely well. And that's just on their own merits. I mean, let's not talk about if some, money starts flowing into the space. I mean, like you said, Virginia's a tiny company. Good luck trying to buy that thing, right? I mean, it's the bid-ask spread is huge on this thing. And so, you look at, I think it traded, like $60 yesterday. It was crazy, right? So, a lot of these things, if there is real genuine investor interest that comes into this space, there's going to be a significant revaluation, I think, across the space. And so that's why, look, some of these things are probably duds. They might not get dug up. And so that's why, our positions in some of the ones are almost more like options, right? I mean, we have a small position in Virginia. We have a small position in some of these more non-traditional jurisdictions. That's not the heart of our portfolio, because we think, sure, they have extremely cheap pounds in the ground, but that's, not all pounds are created equal, right? And so I think, maybe that's in a sort of speculative frenzy, these things will get bid up. But really, I mean, there's probably only a handful of them, at least in the near term, that are going to be turned into cash flow. It sounds like the Africans are the nearest to the green light. Maybe the U.S. Gets sped up if there is some positive 232 momentum, but it's hard to really say. And so that's why we just kind of sit back and, going back to our earlier in the conversation where we talk about, having these things that are convertible to cash in a downturn, you accumulate these positions over time, and, on any given day, some are up, some are down. If we have a value estimate that's much higher than the current level, well, we can accumulate these over time. And if one wants to go on sale, hey, we'll take some of that today if our value is still much higher. And, that way we can be a little more flexible, keeping in mind that we have this sort of list in our mind of how these things should be ranked. And we go that way, and then it's a new fund. So every month, new funds will come in. That cash infusion will sort of dilute our weightings, and then we can selectively rebuild, whatever kind of is top of mind at that point back up to kind of the level we think it should be.
Sure. And, the thing is you do have a number of different considerations. I mean, yeah, sure. Even the clowns of the sector will do pretty well in comparison to other types of investments. So even it's just like if you look at the rage that went on in the cryptocurrency space, even and most of them are fakers anyway, but look how they still went up.
Yep.
And so there's a piece of that there's an aspect of that will flow here just because of the sheer smallness of the sector and such few selection. And then also, some of the New York listed companies, or even really the ones that are listed on the New York Stock Exchange, you're gonna see flows go there. Your Energy Fuels, your Energies, your Uranium Energy Corps. I mean, funds will flow there regardless of what I think about the companies. Funds are still going to flow there because it's an NYSE listed equity, and so it's going to.
Yeah, well, I just had this chat with someone the other day. Is certain companies, won't name any names, are considered more promotional than others, or they're kind of doing the dog and pony show circuit and drumming up business. And I guess in sort of the short term, that's maybe bad if they do more dilution than the others, and the stock price reflects that. But if there is this sort of general investor move towards the space, ironically, those that are the most visible might do the best, even if their assets don't support that, right? And you can actually see that in the liquidity of the names. I mean, look at the sort of the dollar volume that trades in some of these names. It's not necessarily proportional to the quality of their company, right? And so,
correct.
If and I made the joke, if you have uranium in your name, I mean, imagine if there is, the stock does do somewhat of a repeat of last cycle and this thing goes parabolic. Well, you're going to have these guys pull up their iPhone and go on their stock app or go on, Robinhood and type in uranium. Who's going to pop up, right? I mean, not everyone's doing the sort of due diligence that, the people in this that are really focused on this are doing, or, the guys that you have on your interviews. And so I think, and even now, it doesn't seem like, the investor sentiment appears to be improving and awareness appears to be improving. But, I was just talking to a group yesterday and their response was, okay, that all sounds great, but why isn't anyone talking about this? Why isn't this, if this is so great, like, why isn't it going? And I'm like, well, I don't really have an answer that I think they will. I think there will be a time in, 6 to 12 months where this thing's on fast money and, these talking heads are talking about it. They're not probably going to be in there early. A lot of times the sell side, the thing doubles or triples, and then all of a sudden they come out and initiate on it and say, oh, here it's going to go up 30% or whatever. They don't maybe want the career risk to try to put the flag in the sand and say, hey, this thing looks interesting. There are some guys that are out there that are doing it. And usually, I think it has to do with the fact that a lot of these companies are so small, they are uninvestable from institutions. I mean, unless you have these smaller niche funds, there just aren't that many options for this. So, what are you going to do? Buy Cameco, buy NextGen, some of these names that,
Sure.
Have bigger market caps. Like, who's going to be buying, Virginia Energy or some of these little explorers up in Athabasca? But that said, I mean, we think some of these are very interesting because, maybe either you have a large resource that's trading at, that's could be ready to go and it's just waiting on a price. So it's kind of an out of the money option. Or you have some of these explorers up in Athabasca where they have great land packages. They might be near big discoveries. They might have big discoveries themselves, and yet they're trading at, these minuscule valuations. That seems like it's going to change in a big way if this plays out like we think it will. And so, we're happy to just kind of sit and wait. I mean, patience is tough. Our investors, they know that it's going to take maybe a year or a few years to play out. But, if we're right about the return potential for some of these names, the time horizon, all that does is adjust your IRR, right? I mean, if you think a company can double, well, even if it takes 2 years, you're at, 40% or something. If it's 3 years, you're, whatever that is, 20%ish. That'll take care of itself. And so really the question is, can you identify the companies that do have that return potential? Because then, it's almost that venture capital mentality where you build a basket of these things. If you are able to include in that subset some of these names that have significant, extraordinary upside potential, well, that's really going to make up for a lot of the names that don't do poorly. But we think, a lot of the names are going to do well. So overall, the basket should do extremely well compared to, any other sort of investment, a group of names or any other sector. And so that's why, we're really excited about it and think it's worth the time, and for your listeners, listen to some of these CEOs you're talking to and some of these old hands in the industry. I mean, it's really valuable information. I love, like I said, I was just listening to the one before we jumped on the call. So I think it's great what you're doing. And I have a feeling, roll down the road a year or so, a lot of people are going to be like, man, I can't believe these things, what they were trading for back then. This is just crazy.
Right. No, and with people need to. We've all got a bunch of time on our hands right now, in relation to the context of time for this cycle to play out. And so as time goes on, more research is done, more due diligence is done, more you get to see what the actors and the management teams and these companies are doing during these times. You get to see what their costs are. You get to see what G&A is. So for the people the investors and speculators in this space, you have time to take a look at, do I agree with what this company is doing, and is there better opportunities as you continue to spend time doing research and trying to maximize that potential upside. And so it's really on the investor and speculator to make those decisions and put in that time, and perhaps there's a good chance that those who put in a significant amount of time really figuring out the space might actually do some outperforming. And the other part of that is too, Brian, is you have the companies that actually there's a real desire with some managements to actually make a company an operating business that has cash flows, that actually wants to actually make a mining company that will actually have an impact on the market. You have some that want to develop. They're not mine builders. They're not mine operators. You have some that are discoverers and folks that will delineate an asset or a deposit somewhere in the world, and they'll look to hopefully sell it. You can refer to the last cycle. There was some pretty high profile sales that were quite impressive. That happened. So there's the folks out there. There's people that are geared in that direction. There's people that are geared to making a company that is not just focused in Africa, not just focused in the Athabasca Basin, not just focused in the U.S. I think maybe this time around, when things start going, there may be a couple select companies, a couple select people that may desire to make a pipeline of projects, may find a project, have a mine that actually goes to operation, produces cash flow, but at the same time might be punching holes in Australia, might be punching holes in Canada, might be doing something in the U.S. So they're expanding and creating a pipeline. They're creating a jurisdictional company with different contexts of time. For example, like you said, in Africa, you can do something in Africa. You might be able to get something started earlier to take advantage of maybe earlier times. And then with that, you might also have a Canadian asset that might be in permitting that's going to take 5 years or, maybe take longer. I mean, I'm sorry, the fissions and the next gens and so forth. I mean, it's great. Things have been discovered. That's already happened. That stage has happened. So discovery is over with. Now you're looking at financing. You're looking at long-term permitting. You're looking at infrastructure. You're looking at all these development challenges. And, that's reflected in the share prices. That's reflected where they are at this stage in the game. And so you have to look at, hey, do I want to get involved with maybe some development stories? Do I want to get involved with some folks that are kind of at the early stage area, but they can, because of the jurisdiction, go rapidly to potentially a project, building a project, and actually producing something within the cycle? And then do I look at the folks like the Energy Fuels, or maybe the old Paladin that's in care and maintenance, folks that have infrastructure in place, maybe that can turn on and actually get some cash flowing quite quickly. So you have to identify, and then there's just the wild speculations as well, which we've already kind of touched on a couple. So you have all of those realms and all of those pieces, including New York. Where are the listings at? What's that status?
Yep.
How's that going to work? And so you have all that plays into it, and do you have a piece? Do you have kind of all the different pieces of pie? Do you have the kind of the pumpkin, the cherry, and the cheesecake? Do you have all of those pieces kind of on your plate?
Well, and that's you've essentially nailed it. That's exactly the way we think about it, and think that different of those risk factors, those buckets will be valued by the market in different ways, and it might come in waves as certain parts of it come in vogue, or depending on what happens with the price, depending on what happens with long-term contracting, whether certain jurisdictions come in and out of favor. But that's why we like this broad-based approach, because we can sort of kind of cherry pick what are the best names for each of those risks, that each of those risk buckets, and then hopefully that whole pie has a nice average return, because we're not sure which one of these things is going to be the next Paladin, which one's going to, guys will debate it all the time, but I think there's taking this portfolio approach where we have all those different components, it should give at least our investors, it should give them comfort knowing that they have that whole spectrum of exposure. And so, who knows? Maybe it might be one of these little rinky-dink explorers that has the biggest move. Maybe it might be the guys that are able to go into cash flow and do that multi-jurisdiction one. Maybe it'll be a U.S. guy, because all of a sudden we have two-tiered pricing, and Energy Fuels having the mill it goes through the roof. Or maybe it's because of the vanadium, or who knows, right? But all we know is that all of these things are sort of fit together into this puzzle, and we like the fact that we can, kind of have this broad-based portfolio of them, and then as news comes out, as the situation develops, we can kind of tilt it one way or the other and steer it as the prospects of these different companies either improve or decline. And so, I think, there's a lot of really interesting names in the space. It remains to be seen what investors demand. I think, the guys that are the closest to cash flow, maybe some of them are higher cost. The guys that, are the lower cost, it might take them a long time. And so what is the how will valuations shake out of that? And really, it's hard to say, because it's going to depend on a lot of these sort of outside factors getting resolved. We're happy to sort of own this basket of them and just kind of sit back and watch how it plays out.
Right. No, absolutely, and it'll be certainly interesting to take the time between when that actually plays out and now, and kind of refining the portfolio, considering what the broad market will do and how it might affect these little uranium equities, and how one might go about accumulation during a broad market sell-off event. It really is kind of an interesting set of timings that we have going with us, and it'll kind of be interesting to see how it plays out, and see how these management teams manage their capital that investors give to them, and how they spend it. And
and that actually brings up another point, is you had talked about these companies that say, okay, I want to, some are just project generators, and I want to flip my deposit if I find one, and there are other guys that want to actually, I want to develop mines, and maybe not just one. I maybe want to have a multi-mine portfolio across different jurisdictions. I think the conversation you had with Dustin a while back about just are is there enough expertise in the industry for all of these companies to develop? I mean, he seemed to suggest no, that there's going to either need to be consolidation, or some of these things are just going to sit fallow because there's just not enough people that can develop mines. And so that was a really interesting and got us thinking about the different names we own. Is, some of these companies that might claim that they're going to be a developer, well, can they? Is that really possible, or are they going to need to put it in someone else's hands? Who's going to end up developing the Athabasca Basin? Are these individual teams going to build mines, or is Cameco going to come in and these are just explorers sort of developing Cameco's future projects? What's going to happen in Africa? It sounds like John at Deep Yellow is set on developing. It sounds like Daniel Major at GoviEx is set on developing. But what's going to happen with Paladin, right? You just saw the Chinese come and take out Rossing. They have a pretty big toehold in Paladin. Do they take the rest of it? They've come on record saying they need to build a lot of resource. They do own stakes in a lot of these companies. Do they end up swallowing up the industry? They're having trouble developing Husab. I thought that was a very telling comment, that 7 million pounds might be the new number for that versus what was the nameplate originally, I think 15. So there's challenges. They're trying to get it done. And then what does Namibia say when all of a sudden China owns all the projects, right? So there's a lot of these other kind of wrinkles to the puzzle, which makes it difficult to really pinpoint prospectively who's going to be the best guy, who's going to, if I had to pick one name, and that for us, I don't know if we really want to play that game, because you could do all this work and, everything, and you're, all the geotechnical and all the costs and the financing. And then you get hit with, some permit thing, or you get hit with a mine problem, and all of a sudden, you put all your eggs in one basket and the basket broke. So we think, there are a lot of companies that are good here. They're in different parts of the risk spectrum. As a whole, it's probably going to, well, at least for us, it makes us the most comfortable.
Yeah, and you got to have a structured approach to it. You really can, and you just don't. There's unknown things that can happen. Whether it's a management issue, or someone who can't run a mine, or hey, we've got a uranium bear market here, and we need to raise $1.3 billion to build this project. The permitting aspects. Do you have the expertise to deal with the community outreach and these different parties involved? The community outreach and the jurisdictional issues and the permitting issues, and dealing with various agencies at the local levels and state and federal levels in different countries. Different political figures taking over. I mean, example, look at Peru. Peru has different political figures taking office there, and so it's difficult. And then also too, you just never know. Maybe management, are they healthy, or has there been a plane accident? These things can occur, and which could immediately change overnight the thesis. So you do need to have a structured approach. And you need to look at the different realms of the spectrum, whether you're looking at lower risk to the higher risk speculation style stuff. So there's a lot to play into it. And the cool thing is we've got time to kind of run through that and consider that, why we're kind of waiting here. So tell, we're getting up on time. So tell us, how can potential investors that are interested in Old West, how can they reach out to you?
Yeah, so we're set up as a partnership. It's for accredited investors. You can find our information online. It's just Old West Investment Management. And yeah, we're always happy to talk with current and potential investors about the different names we own, our process and philosophy. If you're in LA, you can come stop by and meet with us. And yeah, we're pretty accessible. I usually answer my emails and my phone. So, and look, I love talking about this. This stuff fascinates me. I just love learning about it. My wife's probably a little upset because I, spend all day, scrolling through Twitter and reading, the Namibian times and all this stuff. But it's to me, I think this is a really exciting opportunity. Sure, it's going to take time to play out, but I think that benefits us as investors because we are able to do the detailed work. We are able to build positions in these companies, and then hopefully a few years down the road really appreciate the fruits of our labor.
Yeah, absolutely. And I'm in a similar boat. Whether it's running 14, 16, 18 hours a day. Certainly other parties, at the office and at the household can get a little bit aggravated at me as well. And yeah, no, it'll certainly be interesting, and I certainly encourage listeners to take a look at your guys' website and kind of what you guys are doing, because there is very few funds that at least we've come across. We're trying to seek out some more, but there's very few that are actually looking pretty hard at this space, and it's certainly the early bird is coming on, and hopefully, 5 years from now or whatever it might be, maybe everybody can hook up on Sunset Boulevard and have a good time.
Yeah, and they can reach out to me. I'm on Twitter. I don't really tweet, but I'm pretty good about answering my messages, or on LinkedIn. I'm sure a lot of the people that are listening probably I've followed them because it's one of the best ways to get information. I mean, it's surprising that there's some good solid analysis that goes on that platform and this committed group of investors. And you can't always find it by just looking at hashtag uranium. So I've just been following anyone who's participating in the conversation, because you never know when they're going to like an article or respond to something, and you get kind of a nice little tidbit of information. So they can always reach out to me on one of those things, and I'm happy to chat, because look, I'm still learning about this stuff too. I think anyone that tells you they're an expert, everyone's just there's so much to learn. There's so much that goes into all these different companies, and what the quality of their assets, the structure of their financing, the management. It's a continual learning experience. I think luckily for us, the stocks, I mean, some of them have started to respond, but they're still pretty much depressed, given the improvement in fundamentals that we've seen with kind of these catalysts that have occurred. So I think there's still time for investors to do the work and to understand. And I'm happy to be whatever resource I can be if people want to talk about it. And so and look, I've actually been pleasantly surprised that, like you said, I heard Dustin talk on the interview and kind of reached out to him, and we had a great conversation. I think maybe these people have just been so they're so beleaguered with this industry that they're happy that finally there's some new interest in it, and they're happy to talk. But I thought your conversation with Mike was great, and he said, look, these old geologists, these guys have been in the industry for decades. I mean, it's just what great valuable information. They know these projects, they know the histories, and you really get a good insight. And that's why I like, and I reached out to you for the Virginia interview, and when you were asking for questions, is what you're doing, I think, is a great service to investors. They should listen to the interviews that you've done, the long format, the good questions. You really pick up a lot of good stuff. And I think, for anyone that's committed to this space, that wants to learn more about it, that's a great way to go about it.
Right. And for us, we do these interviews. It actually costs us money. We're the ones who are paying for the services. We're paying for the recordings. We're paying for the technical back down on the backside here. So we actually bring these companies on. We pay to have them come on, and they don't give us anything. So what we try to do is we try to find the Dustins. We try to reach out, even though it might have took many phone calls, many emails, and many types of communication methods to try to get a hold of some of these folks. But Dustin came out as a thanks to John at Deep Yellow. Had it not been for John, the relationship with Dustin may have not come apart. Come to us, and that's important to find the folks that have the integrity and the credibility is what we're trying to seek out. We're not trying to seek out the scripted promotions. Absolutely not. We would rather.
Yeah, and you can get that anywhere. I mean, just go to a conference or go look at a presentation. So that's why I think having those sort of resources that are, more off the beaten path, or that they have the experience. And, one of the things I like is when you ask the CEOs of these guys, what other company do they like? That's a really good question. What's your second favorite uranium company? Because then you get a really interesting view of how they view the landscape, of how they view management teams and assets, and what's going to get developed, what's not going to get developed. So that's one way to go about it. And then I think having all these guests, you're going to build this repository. Eventually, that's going to help you when you go approach new ones and say, hey, look at all the guys that have come on here. We've had good conversations. Look at the investor response. So it should snowball from there. And hey, I'll be a listener. I look forward to all these things. So I just know that we appreciate what you guys have been doing.
Yeah, and we'll keep them coming. It's just kind of a push here, just out of the gate. We're doing a lot right now. It seems like we're doing one almost every day, but we'll slow down. And the goal was to kind of cover some of the companies, and not all of them we agree with 100%. We're bringing them on to discuss things with them. We're trying to get what the viewpoint is today versus when we first found them, and we're trying to twist their arms with some tough questions. And we're just trying to get more information and trying to supplement our research, and also provide some entertainment and a little bit of wisdom and knowledge for the folks who are listening. And so that's kind of the goal here. And hopefully we can find some value added at the end of the day. And so that's kind of how we're approaching it. So Brian, we appreciate you coming on, and we look forward to having you back again soon.
Well, thank you so much.